Hello everyone, we are back with another episode updating a monthly portfolio, and to go ahead and get started, let's look at the monthly portfolio balance. Last month, November 1st, we finished out with $36,738, and this month we finished out with $43,038. So you can see that we had a big ramp up, roughly about $6,500 or so, and this is a big move up, mostly due to the stocks in our portfolio going up higher in price. Now we're going to go over this portfolio. We're going to talk about the growth portfolio and the dividend growth portfolio. If you aren't familiar with these, I update these every single month, and this is my current allocation for my growth. And then we're going to talk about the dividend growth portfolio today as well in depth, which has all 19 dividend growth stocks that are very defensive growers that plan on defending your portfolio despite inflation, despite recession. No matter what the economics are doing, these are going to continually pay you out solid free cash flow. Not only that, but we also display our performance. This is what I look like compared to the major indexes year over year. This is my portfolio in red at positive 2.21% versus the S&P 500, which is negative 13.1%, the Dow, which is negative 2.89%, the NASDAQ, which is still an astounding negative 26.13%, and then finally, last but not least in orange, we have the Russell 2000, which is negative 14.91%. And if you want to see these firsthand, this is my brokerage. Right now we have 42,894 as of the time of filming. And if you look at my balances over time and you look at my performance, you can see that it shows this portfolio what I just showed you mapped out. This is literally just the numbers that is directly from the brokerage that provides me these returns and updates them every single month. This is as of just a couple days ago from the time that you're watching this. So you can see that so far I'm beating all the major indexes. All the four here, the S&P, the Dow, the NASDAQ, and the Russell 2000 are all in the negative, and three of the four are down negative double digits. And so far this year, not only are we not down double digits, but we're actually in the green by a very small amount of 2.21%. So that's great to see there. So if you want to see how I invest, the companies I invest in, this is the video for you, and we're about to go ahead and get started. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up today using my special referral link, then you can receive $10 plus an additional 15 free stocks pending certain deposit requirements. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Welcome back, and we're going to go ahead and get started because it's really quick. The four stocks in the growth portfolio, very quickly my allocations behind these companies and the reason why I'm invested in them. So to get starters, let's go ahead and start with ticker symbol CRM Salesforce. This is a subscription-based company that is still growing 20+% despite the recession. Now this quarter was finally a slowdown. They're finally getting a little bit of pushback, and this quarter only grew 14.19%, now reaching $7.8 billion. And this company has come a long way. Because what's funny here is that if you look at the price, the last time that the company traded around this price, you can see that it was during the 2020 COVID pandemic. And this even goes so far back, trading at the same prices this was in late 2018, so 4 years ago. Just to see how much this company's grown, 4 years ago, this company was doing roughly $3 billion in revenue a quarter. Now, if you look at where they're at today, they're now doing almost $8 billion in quarter. So you can see that they're about 2.5x in revenue where they were just 4 years ago. And so I think this bodes well for the company's stock price that is likely undervalued. Same thing can be said for profitability. If you look where they're at in the most recent year, they're at $5.28 billion. If you go to 1, 2, 3, 4 years ago, it was only $2.2 billion. Once again, about 2.5 times higher than that of the profitability, and so the company's valuation, in my opinion, is undervalued. Same thing can be said about Google stock, in my opinion. This is highly a valuation play. The company has over $100 billion in cash outstanding, just ready to go in its checking account that can be deployed at any moment here. And if you look at how ridiculous this cash pile is, in the most recent quarter, it was a reported $116 billion. And that can buy back a lot of shares, which the company has been doing back in the last year or so. You can see it's gone down from a previous high at $13.9 billion in 2018, and it's trended down every single quarter, especially here in 2022. Now breaching just above $13 billion. I'm sure next quarter will be below 13. Next, we have Amazon. This is one that I'm a big better for AWS. And the funny thing is here is that when you look at Amazon being one of my top holdings, if you look here, you look at my projections over time for Amazon, the reason why I'm so bullish on this company is that if you look on my 5-year out projections and the models that I try to map out for the quantitative for this company, if you look at this column, the AWS column, it makes up the vast majority of my future projections for operating profit. The problem is, right now, it doesn't generate nearly as much money as it should compared to a company of this size. However, this company will be successful in the long run. Not only will it continue to grow AWS, but its other sectors as well will of course grow, and the AWS backlog is getting massive. Furthermore, not just AWS, but North America and International is growing massively from its monthly Prime subscriptions, from its third-party seller services, plus its other acquisitions that it's buying like One Health, like iRobot, and many other names included in the overall business model that is just driving that revenue up. And don't be surprised if this year, based on the projections we have so far throughout the fourth quarter, based on what we're finishing out this year, Amazon might finally break $500 billion in revenue. $500 billion, which is just insane. And then lastly, the only company that I didn't mention here, the only last one of the four is Crocs, which has done extremely well. My average cost basis on Crocs just a few months ago, when I initially bought this position, was $76 a share. And this company had a huge ramp up in revenue from its Hey Dude acquisition, and I'm just seeing these shoes everywhere. If you look at this on a quarterly basis, you can see how it's starting to skyrocket and that acquisition is starting to pay off. As this company eventually pays down its debt, that is not so great for the company. I think as this slowly trickles down quarter by quarter, the reasons for investors not to invest in it are slowly going away. So that's the growth portfolio, and now we get to the thing that many of you are here for, which is the dividend growth portfolio, and we're going to lead that off with the largest position, WP Carey. WP Carey, I always like to bundle up with real estate investment trusts that I own in the portfolio, which includes 3 different companies. It's WP Carey, it's Realty Income, ticker symbol O, and then lastly, we have ticker symbol VICI for Vici. And these make up 6, 9, and 10% of the portfolio, and all of these are great long-term compounders. If we look at this, one thing I pulled up here already, if you look at the quarterly dividend for a company like WP Carey, it is absolutely incredible. Notice going back here to 2013, it goes all the way back to 89.5 cents, up to 90 cents, to $1, to $1.05, to $1.06, and it gets raised a small amount every single quarter. So if history tells us anything of how this company's been able to generate profits, then it's likely going to be a telling sign for the future that this could be a successful business. Same thing can be said for Realty Income. This thing has a super long track record, it pays out monthly, and it raises out at least quarterly. Look how high it goes over time. And the same thing can even be said about Vici, who is a newer kid on the block, doesn't have nearly as long as a track record, but since its initial public offering in 2018, when it paid out 16 cents every single quarter, it's raised it to 26 cents, to 28, to 29, to 33, to 36, and now the most recent raise of 39. All 3 of these run very lean business models and receive lots of revenue and profitability from owning properties and leasing them out in the form of a triple net lease. And if you don't know what that is, it basically takes a lot of the liability and a lot of the hassle of owning real estate off of the real estate holder, like a WP Carey, like a Realty Income, like a Vici, and transferred it over to the people that are actually renting out the properties. They have inflation adjusted contracts already factored into the price, so they will go up over time as CPI rises with it, so these companies are bound to get more revenue and more profitability as long as the people are paying the rent. So those are always going to be 3 core holdings, and they're a reason why I like them. Now, next up, we have a company that is not a real estate investment trust. It's a financials, and it's the largest bank on the planet, which is JP Morgan Chase. JPM has started to recover quite nicely, and I was really loading up at around $100 a share, and you can see that now it's trickled up higher. Now it's at $135, roughly 35% off the lows, so it started to recover quite dramatically. If you look at this on a 5-year basis, the last month or two, this company's just been on a rocket ship higher, and if you look at this on a 3-month basis, basis, you can see how apparent this becomes. Up 18% in the last 3 months, up 5% in the last 1 month, and even in the last 6 months, it's recovered all of those losses. JP Morgan Chase is starting to get back to a more fair valuation. Don't be surprised if this holding of 10% gets changed very soon. I likely project that I'll change it likely within the next couple of weeks, probably in the month of December, because I don't want it as high a position since it's recovered so much. And speaking of stocks that have recovered so much, and in fact have break new all-time highs of $500 plus a share. If you look at the $500 chart here, you can see that the company almost broke 500. If you look at the weekly chart here, this company almost broke 500. It was 498.70 to be exact, but this company has been on a rocket ship to the moon. If you look over the last couple months, it's just been ridiculous. Over the last 3 months, it's up 18%. Over the last 6 months, it's 12%. Year to date, which keep in mind, this is a time when typically the market is down. If we go back here to my holdings and you look at the performance, you can see the S&P 500 this year is still down 13%. Not only is this company not down 13%, Lockheed Martin, ticker symbol LMT, is actually up 40%. And that is because this is a company that primarily relies its revenue and profitability off the United States government, off the military, more specifically focused on the Air Force. This is one that is a big benefactor from its long-term contracts, from its high price market, its high barriers to entry, and overall, they just have the best customer in the world, which is the United States government. This is one that's been very successful. It's exceeded any expectations I had for 2022, and I likely will be rotating out of this into more battered down positions that aren't doing so great. Now we move to Visa. This is one as an example that hasn't done so great as well. It started to recover some, but it's pretty much been flat over the last 2.5 to 3 years. And this is because the company has been growing nice, but that margin compression, that valuation compression is starting to be faced by Visa. If you look at this company's stock price, if we pull up ticker symbol V here, you can see how it's recovered quite nicely from COVID. You can see the highs from pre-COVID highs was right around 6.1 billion. It just shot right past that, and now the most recent revenue in the most recent quarter is actually 7.79 billion. This represents an astounding growth of 18.72%, but it's not just top line because the company has higher revenues from prices going up. This is a company that has also increased profitability in a big way, growing 48.31%, reaching 5.5 billion. As you might guess, that has increased the cash pile significantly over time. As you see, it's generally trending up and to the right, with the most recent quarter having 18.52 billion, which is pretty comparable to the debt load of 20 billion. They stay pretty much 1-to-1, generally speaking. Sometimes it varies a little more than the other, but they continually raise debt and raise cash, so they have a lot of firepower, and they use that debt as leverage to continually grow the business. And then, of course, they do lots of dividend raises in the most recent year, going up 20%. That's right, 20%. And also buying back shares. In the last year, they bought back 2.5% of the company, which is pretty impressive considering it's a company of this size currently sitting at $462 billion. Visa will continually be one of the top positions in my portfolio for likely a long time, and it's one of the big reasons why I love this company is so much meat on the bone on the profit margin, currently sitting right at about 50%. The company has 50% margins. You heard me right. Not 30, not 5, not 12. This company has 50% profit margins, meaning half of all revenue they receive goes straight to the bottom line, which is absolutely impressive and almost unprecedented in any world of economics or finance. You almost never see something that juicy and that big for any sector, regardless of what the company does. So it's a company I love, and this moves me to Broadcom. Broadcom is one that I could very well be increasing my position in, and this is one that's been a great dividend grower. I'm really interested to see what they raise their dividend to. Actually, they may have already announced it, so I should go ahead and pull it up to see if they have. Let's go ahead and take a look. Nope, they haven't announced it yet. They do typically raise around this time, right before Christmas, right around mid-December or so. They generally announce a big dividend raise, and last year they raised it pretty significantly. If you pull up Avgo's chart here, they did raise their dividend a substantial amount of 13.89%, which is pretty impressive, and that might not be as high as Visa. However, the difference here is if we pull up Visa, you can see that Visa's dividend yield, as of the most recent trading day, currently sits right at about 0.86%. You can see me highlighting it right here. Now, if you do the same thing, but you pull up Avgo, which is basically Broadcom, you can see that their dividend yield as of right now is 3.15%. So it's about 4 times higher than that of Visa, and they're growing it at almost the same speed. They grew at 13.89% last year. We'll see what they raise it this year. And this is a company that can be a bit cyclical. However, the one thing that is a big caveat for this company is that they're becoming less and less cyclical because they're big in the M&A activity, which is mergers and acquisitions, and this is leading them from their old school hardware business into newer school software businesses. And this is getting them a lot more reliable revenue, and you can see this is going up over time, growing 24% year over year, and the profitability is doing a similar 25% growth year over year. Most recent quarter was $4.31 billion, and the cool part to see of this over time is how this company is continually raising its dividend and buying back shares as of the most new recent buyback program here in 2022 with the stock price going down. The cool part is too, you can see from the initial metrics back in 2020, they initially had a return on capital employed of 1%, and it's been raising every single quarter since then, currently in the most recent quarter going up 6%, and the stock price is not doing very well in 2022. Year to date, it has started to recover, but it's still down 18.69%, down 2.5% over the last year, but from those previous highs of around $675 a share, this company's come down quite considerably, and when I'd really be interested in loading the boat is if this company were to go back down to the low 400s or even the 3s, that's when I'd really look at buying a lot more of this stock. We already talked about Beachy, so I'm going to skip that one. Now I'm going to go to Home Depot, one that has been beaten up pretty bad, and it started to recover some, but is still down 20% year to date. And you can see it, this company is just, it's a long-term performer, guys. Even with this company being up 81% in the last 5 years, this is nothing compared to the long-term trend to how shareholder returns have been provided from via HD stock from Home Depot. It's just ridiculous. Over the last 5 years, like we said, it's about 80% higher. Over the last 10 years, it's 412. Since its inception, since going public, it has 1,000,000% stock returns. That's not a typo. That's not a mistake. Pull out your calculators. The stock going back to IPO, due to the splits and how much this company's moved around in stock price, it initially went public at around 3 cents a share. Today, it sits significantly higher at the most recent trading day at $300 a share. This has been a long-term compounder for decades. Going back to its initial IPO in the early 80s or late 70s, whichever it was, this company has been through up times, it's been through down times, but generally speaking, it's been a long-term compounder. You can see that over the long run from its dividend payments. See how incredibly high this dividend payment has gotten compared to where it was decades ago, and it seems to do nothing but go up. We're due for another dividend raise soon. I don't think they've announced it yet. Let me double check here. They usually update this website pretty quickly on how fast they can update the dividend price, but let's go ahead and look at the most recent quarter. Let's see, they have not announced it yet. They'll probably be announcing it based on their yearly schedule. They typically announce it around February, so it'll probably be around 2 or 3 months from now. But this company has been raising its dividend big time. In the last year, it raised it 15% for what is already a pretty considerable yielder of 2.41%. Revenue has started to kind of flatten out. The growth has not been as exponential as it has been, but honestly, people are pricing this company for far worse numbers than it's actually doing. It's still growing 5.5% year over year, which is not bad at all, and the profitability has gone down, and that's the big reason why. Not because of the top line, because of the bottom line, going down 24% year over year. If you look, you can see it's generally trending up over time, and now we get to 2022, and we're starting to face a little bit of headwinds. However, this company is still very profitable. It's one that I am very excited for, and they do carry a lot of debt, which I don't like, but so far the cash flows have been pretty sustainable. I would like to see them pay off this massive debt pile. It's one of the few things that's keeping me from just loading the boat and making this the biggest position in the portfolio, but it is one that I'm confident in. One that I bought a lot more of, Whirlpool. It just trades at a disgusting valuation. It's so low. Now let's look at Home Depot. This is one we were just looking at before. It trades at what you consider to be a pretty standard valuation, 18-19 PE ratio, and that's pretty average generally for what you see in the market. What does Whirlpool trade at? Its PE ratio is currently sitting at a forward rate at about 10. 10, significantly lower. This year's PE is about a 5, and they did lower their guidance, and that's what caused this stock to get slammed. Similar to Home Depot, the profitability is starting to go down. They even had a pretty nasty unprofitable quarter, and this company has not produced the free cash flows it typically does. However, they still have a lot of cash on hand, and their balance sheet looks significantly better than Home Depot's. With their cash versus debt pile, it's not even close compared to Home Depot's, and you can see that over time they've been raising that dividend significantly. 25% raise last year, and in the last year they bought back 12% of the company stock. This stock price, or excuse me, these shares outstanding, I should say rather, are going down in a big way. Millions of dollars a quarter, and the management team doesn't plan on slowing down now that the stock price is reaching new lows. Buying back shares at 250 plus over here is not nearly as good as the company or the actual management buying back shares at today's prices at 130, 140, 150. You can get a lot more bang for your buck. Whirlpool is not the most exciting business in the world, but it's one that's a low valuation, a good yielder, and one that provides a lot of capital returns to shareholders. We've talked about Pepsi so many times on this channel, and look at how beautiful and, more importantly, consistent that stock chart is. It's just ridiculous. I don't need to explain Pepsi to you. It's a long-term compounder that continually grows from acquiring new snack and food products and continually growing its old school beverage products that continually raise prices and are inflation hedged, which is why you see this company's revenue continually go up over time. You can see that just in the last year, it went up pretty consistently. Last year, it put up a revenue number at $20.19 billion. This quarter, it put up almost $22 billion. So that's about a 10% increase year over year, and Pepsi is about as consistent as it gets. And many of these names, as we get through the core holdings, are pretty much as consistent as it gets, as you'll see from the long-term trends of these companies. 3M is one that I've talked about before, one that I've considered lowering in the portfolio because it's not one that I'm super confident in growing, because the growth, or should I say lack thereof, is pretty much non-existent. Negative 3.61% growth. In a time when the economy has boomed, this company barely even uptrended in revenue, and even with inflation going up, they haven't really been able to raise prices, and it's one that's overall been a sad story. Profitability has started to trend down as well, and I basically can say, I hate to admit it, there's a reason why this company's stock price has not done well in the last 5 years. And even when you look at this on a 5-year basis, you see a negative 47% return, but even on a 10-year basis, only up 40% in a decade, especially during some of the biggest bull markets ever, that's not very impressive. And this is not by accident. The company has not produced returns that are ample enough for shareholders to be excited about owning this company, and I would be including that. I don't think I'm going to sell the holding. It's one that I'll continually hold because it's gone down so much. It's at a decent valuation now, but it's not one that I'm super confident in. There's a reason this company trades at a 12 forward PE. It's cheap, and it should be. Next, we have Target, and this is one that has been hit really hard in 2022. You had some major issues with things like inventory, which was this huge spike down. If you look over the last 2 years, you can see there's one big spike down here. That was when they reported their huge mass in inventory increases. In the last year, it's down 32%. In the last 2 years, it's pretty much flat, down negative 5%. And then the last 5 years, and the further out you get, you see that the performance is pretty incredible. It's been a long-term grower, been raising prices, been attracting consumer attention, and overall millennials love the stock. However, they're not loving it so far in 2022, being down almost 30% year to date. Now, this is one that does finally have a decent dividend yield of 2.61%. They did just raise that dividend not too long ago of 20% higher than a year ago, initially paying out 90 cents, now paying out $1.08, and this company consistently buys back shares at a pretty substantial amount, buying back 6.4% of the stock in the last year. Just about a year and a half ago, this had 500 million shares outstanding, and now it only has 461. So they bought back roughly 8% or so of the business just in the last year, year and a half, and that is what I like to see as an investor, as a shareholder of a business like Target. However, they're using a lot of their cash because that debt pile is free falling. What was initially just 2 quarters ago $6 billion now sits at 1.1. So they're running out of cash, and that debt pile is going up. I don't like this. I don't like to see this. It's not something I like of Target, and I would like to see them improve this, especially once we get out of the recession. The 2 most recent quarters were actually free cash flow negative. Not positive, but negative, and one of them being significantly lower. Look through all the major times here when this company was scaling out the business, and there's one quarter that stands out. It was the first quarter of 2022 at how bad that was. The company's trying to get back on its feet and regain traction now, but we'll see how the company goes throughout the rest of the year. Kimberly-Clark, I won't spend too long on. It's pretty much one that, it's so boring. It just does the same business over and over. It slowly grows and raises prices over time. But let's not even look at a quarterly. Let's look at it on an annual basis. Pretty much since 2008, the company's had flat revenue. If you look since 2008 on an annual basis, the company has had pretty much flat profitability from 2008. In 2008 had 1.61 billion in free cash flow. Last year had 1.72. Almost the exact same. So the company just pretty much does the same business. However, there's one thing that typically changes over time. The dividend tends to consistently go up, increase, and you also typically see shares outstanding go down. Because these products are so consistent, this company produces a lot of cash. Like many of the businesses in the portfolio, they have a lot of cash that they produce, typically producing in the last 5 years or so an average right around 30% on capital employed, which is really, really good. Operating margins are stable for this company, generally trending around 15% or so. It varies year over year. And then profit margins seeing a similar rate at around 10-12% or so. This company is consistent, it's boring, and it's a stable stock for your portfolio. It's not one that's exciting. It's not one that you're going to double your money in a year on. And it's just one that you can consistently sleep at night, get dividend checks at 3.5% currently, and the company will consistently buy back stock. If you look on a quarterly basis, like we've seen with many of these companies, they've been buying back stock on a pretty slow rate. It's starting to flatten out here in 2022, but long term, this company buys back shares and makes it easier for dividends to be paid out. And now if we go to the next company on the list, you see that we have Procter & Gamble. And it's funny because these two tie in with each other, talking about consistent. Procter & Gamble is about as consistent gets. It's one of the most popular names when you think of defensive stocks in the stock market. This company has a track record that's 100 million bajillion years old. You only see on the chart here through Qualtrim going back to the 80s, but this company's been around for over a century. And they have been producing profits for, you guessed it, over a century. It's an easy one to name. They have so many brands. They have so many names that just generally over time, as the economy grows, there's no way that Procter & Gamble doesn't grow alongside it because they're so dominant in many big names like Walmart, Target, Amazon, Costco, Kroger, Aldi, you name it. They're in pretty much every single store on the planet. McDonald's is a company that I like, but has been going pretty much too high in valuation for me to want to invest in it. And even the most recent PE currently sits at 28, 26. So it's not one that I'm super excited about buying a lot of. The free cash flow has been trending higher somewhat, but it's been pretty flat year over year, and the revenue has not been going up at an impressive rate going back to 2014. However, the valuation is going up over time, and the company carries a lot of debt. However, like many of the companies in here, you're starting to see a trend. It's pretty consistent. It doesn't have a super high dividend yield. It has 2.2, which is pretty fair. That's okay. But the company's share price has really gone higher, and it's not one that I've wanted to allocate a lot of capital to. NextEra Energy Partners is an energy diversification play that it consistently raises its dividend quarter over quarter, as you can see. So I don't typically go over that one too much in depth. It's mostly a diversification play. Caterpillar is one that has shocked me. I look at the stock price and I just say, whoa. What is going on here? It's one that I hate to want to sell because I like the business. I like the actual company fundamentals. However, the stock price has started to exceed what I consider to be its real value. It has started to hit pretty much new all-time highs in terms of its revenue, growing 20% year over year, and profitability has exceeded my expectations. However, it's typically not the type of company you want to own going into a recession. And if you look over the last 10 years, let's actually look at the all-time chart. When did this company typically face the biggest issues? It's during times of economic recession, during times of contraction, like the dot-com bubble, like the 2008 financial crisis, like this big 2014-2015 downturn it had, like the Chinese trade war, like the big COVID downturn. This is typically a company that's not very resilient during times of downturns. I don't know what just happened to my computer here. I might have to refresh. Okay, everyone, I'm back. I'm not sure what just happened to my computer. But long story short, Caterpillar stock price has just went parabolic for what I ever thought was possible. Still up 14% year to date. don't be surprised if I either lower my position or even completely sell out this company. And pretty much the same thing can be said about Coca-Cola versus Caterpillar and McDonald's. They're not businesses I want to sell, but they're not exactly businesses I want to buy either. The forward PE is 25 on the stock, the trailing PE is 28, and that's not very cheap for a company that has almost no growth in revenues. The profitability is pretty much flat, very slight growth on a long-term basis, and this is not one that I think deserves to be trading as high as it does. It's really a safety net versus the recession. Don't be surprised if I sell out of this and invest in a dividend company that is more beaten down, one that has its valuation contracted, not expanded. Because 25 PE ratio for a company like Coca-Cola, in my opinion, it's just too high. These are the 19 companies in my dividend growth portfolio, the 4 in my growth portfolio, which I likely will be selling out of Crocs soon. In the growth portfolio, I didn't mention that, but overall, these are the businesses I own, how I've gotten to this plus 2% returns. You can follow along with the channel, sign up with MooMoo if you haven't already, so check out that sponsorship. I'd really appreciate it. But other than that, guys, thank you so much for watching, and I'll catch you guys next time.